It is a basic rule of markets that an insolvent company cannot multiply its value overnight without a powerful external force acting upon it. This chart shows the one-year performance of Avis Budget Group, ticker CAR. Following a long period of flat trading at $100, the stock enters a vertical 500% spike, reaching $500 per share. This move occurred on remarkably low trading volume. The mass of retail buyers usually required to sustain a move this large is entirely absent from the tape. The options market is equally quiet. Despite the vertical price action, the implied volatility remains flat, suggesting that traders weren't piling into speculative call options. This behavior distinguishes Avis from retail-driven short squeezes like GameStop. There was no social media-led mob responsible for this rally. Because this spike defies both the company's financial fundamentals and the patterns of a retail squeeze, we are seeing the clear footprint of a hidden institutional force. The entities involved in this narrative are Pentwater Capital, SRS Investments, and the Avis Board of Directors. Pentwater appears to have executed a synthetic float squeeze, a maneuver designed to artificially corner the stock's available supply. The primary tool for this strategy is a derivative contract called a cash-settled total return swap. By using these swaps, an institution can effectively dry up the available shares in the market without triggering the regulatory alarms associated with direct stock purchases. While the trade generated massive gains on paper, the mechanics used to build the position created a significant complication for the eventual exit. The specific methods used to engineer these profits have placed the institutions in a situation where their legal obligations now conflict, turning the exit strategy into a fiduciary prisoner's dilemma. To understand why the price action is purely mechanical, we have to look at the actual corporate balance sheet of Avis. The company carries $25.2 billion in long-term debt, which is used to finance its global rental vehicle fleet. For years, management also engaged in aggressive share buybacks, which significantly drained the company's corporate equity. Against $25 billion in debt obligations, Avis holds negative $3 billion in equity, structurally insolvent. Upcoming earnings projections are also deeply negative, yet the $500 stock price assigned this failing business a $17 billion market capitalization. The stock price became completely detached from the company's survival. This was a purely mechanical event. The float represents the number of shares actually available for public trading. When an entity shrinks that supply, the stock becomes highly sensitive to any buying pressure. SRS Investments already held a dominant position in the Avis float, owning 49.3% of the shares. This flowchart illustrates the concentration of ownership. Combined with SRS, Pentwater Capital built a visible stake of 22%. The bank must physically buy and hold those 10 million shares to pay Pentwater the return. This counterparty hedging effectively absorbs the remaining available float from the public market. By utilizing these swaps, Pentwater synthetically cornered the float. They engineered a massive squeeze while keeping their fingerprints off the underlying shares. If Pentwater had successfully cornered the market, why didn't regulators intervene and halt trading for manipulation? The very first reason involves reporting rules. Cash-settled swaps with unaffiliated brokers do not trigger the same immediate SEC Form 4 filing requirements as direct stock ownership. This delay effectively hides the size of the squeeze from the broader market as it develops. The second major tripwire is the cost to borrow shares for shorting. This chart tracks the borrow rate. In a cornered market, this spikes dramatically. Yet here, shadowed by the 500% price spike, the borrow rate remains flat and low. Pentwater achieved this by letting counterparties lend the swap shares back to short sellers. By actively maintaining share liquidity for their own opponents, they kept the borrow rate artificially stable and mundane. This tactic masked the synthetic cornering of the stock, making the explosive price action look like organic trading rather than a deliberate manipulation. Pentwater currently holds billions in synthetic gains, but to turn that into actual cash, they have to unwind the swaps without crashing the price. This is where fiduciary duty comes in, the legal obligation for management and fund managers to act in the best financial interest of their stakeholders. Avis management is overseeing a company with $3 billion in negative equity. They have a fiduciary obligation to issue and sell millions of new shares at these inflated prices to stabilize the company's balance sheet. SRS Investments has a similar obligation to the people who contribute to their investment fund. With the stock up 500% on a failing company, SRS is legally compelled to sell its position and realize those profits before the price collapses. The two largest entities in the stock are legally bound to aggressively sell. Once they do, the artificial floor beneath Pentwater's gains will evaporate. This matrix illustrates the final standoff, a three-way prisoner's dilemma between management, SRS, and Pentwater. Theoretically, the best path for all three is a coordinated, slow sell-off. This would allow everyone to extract billions without crashing the market. However, coordinating an exit between management and majority shareholders is illegal collusion. They cannot legally talk to each other to fix the price. This creates a dangerous competitive environment. If one entity sells aggressively, they take all the available liquidity, leaving the other two with nothing. If Avis or SRS fail to cash out before the price crashes, they will likely face lawsuits from their investors for missing the window. Every party involved now has a finger on the trigger, knowing that the SEC is looking for collusion, while their own investors demand results. The synthetic mechanics used to execute the squeeze have left the victors in a legal standoff, proving that generating paper profit is a separate challenge from legally realizing it.